to the first episode of the Sydney Contrarian. Today's episode is about why lowering the interest rate is harmful. Now you might ask, how is that harmful? The newspapers keep telling me that it's good to lower interest rates. The government wants us to live in a lower interest rate environment because it'll spur growth, it'll help people who are repaying their home loans, and they also say that lower interest rates are going to improve consumer confidence and lead to economic growth and more jobs. In fact, politicians have been putting down on record in saying things like, for example, Wayne Swan back in 2012, December the 4th, on the Sydney Morning Herald, the interest rate cut, is an early Christmas present that hard-working Aussies deserve. And then, more recently in 2015, on February 3rd, as recorded in the ABC, Mr. Joe Hockey, the previous Treasurer, said he had no doubt that the move would help to lift both business and consumer confidence. This is good news for Australian families, and it's good news for Australian business. It's good news for jobs, and it's a good news for households. This will put an extra $750 a year into the pockets of a typical Australian family with a mortgage of $300,000. Well, there you have it, ladies and gentlemen. The politicians say it, so it must be true. Or is it true? Look carefully at what they said. They say that Australians deserve an interest rate cut. Part of the reason is because there's a lack of consumer confidence, and it's going to help households that are deeply in debt, $300,000 in debt, to save $750 a year. Well, how kind of you, Wayne, to give us a Christmas present where we have to end up paying slightly less. And furthermore, thanks, Joe. We certainly all want to have $300,000 mortgages because we don't have enough to afford our own home through our savings. Now, this narrative of the typical Australian having a significant mortgage, of course they're going to like low interest rates, but then things weren't necessarily always like this. People didn't have to have massive mortgages sitting on them and that they have to look after it for the next 15, 20, 30, or even sometimes 40 years of their life. Now, don't get me wrong. Getting a mortgage is not necessarily a bad thing, but getting a mortgage that is going to tie you down for 15, 20, 30, or 40 years of your life can be quite debilitating because you are actually stuck with it, and you could potentially be making decisions that are pretty much centered around your mortgage. Now, some people are going to say that a mortgage is almost a necessary evil, and that who actually hasn't got a mortgage except for a few lucky ones who were able to pay off their home outright without borrowing from the bank. But that's only because we've been through this whole process for the past 30, 35 years especially, thanks to lower interest rates that are pushing up asset prices in general. And it's not just about property. It's also about shares. It's about bonds. It's also about most investment assets. Now, the only reason why we think that it's all about property prices going up in this day and age is because the media has spent a disproportionate amount of time hyping up property prices and the wonders of investing in property and why you better not miss out because the boat waits for no one. So let me show you how the interest rates have actually been over the past 32 years, and you'll be able to then see for yourself how it has become harder for people to save, and with banks allowing people to borrow more, it's naturally going to push prices upwards on most assets. And then this further leads to the vicious spiral of rising prices and rising debt levels. And later on in this video, I'm also going to show you the effects of inflation. When prices are also rising, it also affects the ability for you to retain your purchasing power. And with a lower interest rate environment, your purchasing power, your ability to actually buy something for the same dollar is going to reduce. So what you have in front of you is the interest rate movements in the past 35 years, since I've only got data going back that much, and you will pretty much get the picture. In fact, it was around the early 1980s when interest rates were hiked up significantly to 15–20% because of the US Federal Reserve trying to kill inflation. And to try to stem this massive price rise of gold as a result of 1971 when Richard Nixon, the 37th President of the United States, took the US dollar off the gold standard. And from there on, gold price actually rose about 25 times. And to kill the gold price rise, they raised the interest rates. And then they were able to slowly reduce interest rates and make life a bit easier, or so they claim. So with the bold black line, that's the interbank overnight rate. This is actually the rate in which banks lend to, the interest rates that banks charge on lending to each other. And it is very similar to the RBA overnight cash rate. And the reason why I actually did not include the RBA overnight cash rate is because data going back before 1989 was not available. But as I saw the rates between the RBA overnight cash rate and also the interbank overnight rate, they're very similar. So you can pretty much consider them as the same thing. This is what we call the baseline interest rate, as in how much is the government and the most secure institutions paying in order to save their excess cash. It is also the benchmark rate in which it determines how much banks are charging for customers who are borrowing from them, businesses who are borrowing from them, and also individuals, businesses that are depositing cash with them. The 1 month, 1 year, and 3 year rates, those are the term deposit rates. Those are what the banks actually pay to a customer who deposits with them over a fixed period. Now, banks in general pay interest on a monthly basis. So the 1 month term deposit rate can be used roughly as the indicator rate for what you are getting in your savings account. Your 1 year and 3 year term deposit rates technically would be higher than the normal savings rate because you are placing an amount of cash with them for a certain period of time and you can't take that out. Otherwise, you have to pay a penalty. So there's a reward for placing your deposits for a fixed term rather than in a savings account that you can just withdraw your cash straight away. As you can see, the interest rates were very high and in the double digits range in the 80s. In the early 90s, the interest rate started falling as a result of the Hawke and Keating government falling into significant deficits. And because the government started to owe a lot of foreign debt, they reduced interest rates, and necessarily then the savings rates also fell. So individuals were earning less interest on their deposits as they would have been in the 1980s. This prevailed throughout the mid-90s, and in battling the recession we had to have in 1993, the interest rates started rising and it went to about 7%. But at the late 1990s, we had the growth of the general economy. We also had the 1998 Asian crisis, and then the dot-com bubble that prevailed into the turn of the millennium. September 11 brought in significant economic hardship as a result of reduced consumer confidence, as well as also the aftermath of the dot-com bubble led to loss of jobs, and the government tried to spur the economy by reducing interest rates. In about 2003, as the recession ended, we had a long period of growth in Australia thanks to the mining investment boom. During this period, the Howard government capitalized on increasing demand by the Chinese on our iron ore, our coal, and our natural resources. Our economy grew and prices began to rise significantly. As we approached 2006, the Reserve Bank of Australia identified that there could be potential overheating of the economy, as in the investments on our property, the investments in our share market were rising too fast, so they raised interest rates to encourage people to save more and to slow down on speculation. But by that time it was a bit too late, because the subprime crisis started to affect the UK property markets, and that spread to the US market, and then it led to what people call the global financial crisis, but in fact it was really the subprime crisis. The true global financial crisis is actually what is coming ahead of us because of what we have done since the subprime crisis, which, as you can see, interest rates started falling sharply in 2008 and only rose modestly between 2010 to 2011 before falling again. The whole reason behind that was because the government and the central bank, the Reserve Bank of Australia, was trying to encourage economic growth by getting people to save less and spend more in order that businesses are going to recover and more jobs are going to be created. So that could potentially lead to an economic recovery. As for the interest rate being paid to those who are saving in banks, whether it's the normal savings account or term deposits, you can see that the rates are at record low levels and have prevailed for the past 5 or 6 years. Currently, a savings account would pay about 1.5% interest. A 1-year term deposit account pays 2.4% interest, and a 3-year term deposit account would pay almost 3% interest. To better illustrate my point about how interest rates affect our ability to save, I've actually proposed 4 case studies. These case studies basically on how much one would accumulate if they saved $500 a month over the 10-year period at the actual 1-month interest rate that banks are going to pay over the period from 1985 to 1995, 1995 to 2005, and so on. My assumptions for each of these are the actual interest rates that were attained on a month-to-month basis. The exception is in 2015, because we're only like 2 years away from 2015. So I've assumed if you actually earn 2% interest each month over the 10 years, how much you're going to have. So as you can see in the graph, I've got the following results. Now the black line on the cumulative is basically saying this is the actual amount you put into the bank, and that should be $60,000 over 10 years. And then the other lines show how much one would end up with in each case. So if you invested $500 a month from January 1985 for 10 years, on average, you would earn about 9.7% interest rate. You're not going to earn 9.7% every month, per annum on a monthly basis. During that period, you earned between 4.3% to 14.4% because interest rates were quite volatile, but they were on the higher end. They were close to 10% most of the time. So over that 10-year period, you would have earned almost $92,000 at the end. Or I should say at the end of the 10-year period, you have $92,000 in your account. Your interest would have been 53% of what you actually contributed. That's a pretty good return over the 10 years. Now, for 1995, if you put in $500 a month over 10 years, on average you were earning interest rate 2.74%, much lower. And you can go back to the previous slide to see how interest rates fell significantly since 1992. And interest rates fell as low as 1.3% and were as high as 5.5%, but mainly around 2.7%. At the end of the 10 years, if you put your $60,000 over that 10 years into a bank account, you have only accumulated $66,572. So you earn almost 11% interest over the 10 years, all up, not per annum. That is a significantly small amount. Now, things don't actually get that much better if you invested 10 years from 2005 onwards. The interest rate was much lower. It was between 1.25% to 2.9%, but you were earning on average 2.4%. The reason being that since 2008, the subprime crisis, the Reserve Bank of Australia reduced interest rates significantly and banks similarly cut interest rates. So over the 10-year period from 2005 to 2015, your $60,000 would have become about $68,000. And your interest earned would have been 13% of what you put in. Again, not very rewarding. Now, if we look at investing $500 a month over 10 years from January 2015 and assuming interest rates are 2% all up throughout, then your accumulated wealth would have been $66,300. And so therefore, over a 10-year period, you earn a total of 10.5% extra of what you invested over the 10-year period. That's actually quite a small reward. In fact, going back to what Wayne Swan was saying, that it was a Christmas present hard-working Australians deserve. That sounds really ironic, doesn't it? Like, I mean, thanks very much, Wayne, for helping us earn less on our savings, because that just really helps us move along in our life much better. It's just ridiculous when you think about it. Now, perhaps I might be a bit harsh, right? That people don't necessarily put their savings into a bank that on just a daily savings account. Maybe some of you might decide that you could put it in a higher interest rate account. So, for example, you could put it into an online savings account that might pay high interest. So, for argument's sake, let's say you're earning a 1-year term deposit rate, so interest rates are going to be a bit higher. The results are not that much better. Let's go through them. So, over 1985, over the 10-year period from 1985 to 1995, the interest rate would have been on average about 10.75%, and your accumulated wealth, like how much you get in your bank account at the end of the 10 years, would be $97,000, which would be about 61.5% of what you initially have put in. So that's, again, as I said, quite rewarding. You really can go the distance with that type of earnings without taking too much risk. You don't have to go and rely on investing in high risk investments in order to earn a return to sustain your daily living. And now if you look at the 1995 to 2005 results, again you can see that over the period for both cases of investing 10 years from 1995 to 2005 and 10 years from 2005 to now, to 2015, the interest rates have fallen on average, like you have earned an average of about 5% interest. And there were some good days where you were earning over 8% interest, which would be quite comfortable in most cases. But averaging it out over the 10-year period, the amount that you would actually have in your bank account after 10 years would be $75,500 and $76,000 respectively. In fact, you were worse off in the mid-90s investing over 10 years than you were in the mid-2000s, even given the subprime crisis. But remember that the banks reduced interest rates over the 35-year period, and interest rates fell much more in the last 15 years than they had prior to that. What happened was banks actually paid much lower interest rates as the economy became weak after the dot-com bubble and also September 11. So that's why you actually earn less over the 10 years from 95 to 2005 than 2005 to 2015. But the joke is further on us. From 2015 onwards, I'm assuming that you would earn 3% interest per annum on your high interest savings accounts. And even now, especially nowadays when interest rates have fallen to 1.5%, it's very hard to get a bank to pay you even over 2.5% interest rates on a high interest rate bank account. So therefore, despite me giving the benefit of the doubt to banks, you're still much worse off. At the end of the 10 years, at such low interest rates of 3% interest, you would end up with less than $70,000. So over 10 years, your interest earned would be about 1/6 of what you have put in. Now, as I said before, low interest rates, now you really should see from a savings perspective, low interest rates is really putting a dampener on your ability to accumulate your wealth. But the newspapers and the online media and the talking heads on TV keep talking about borrowing. It makes life easier for the borrower. But where do the borrowers come from? The borrowers are there because they couldn't save enough to get what they want. Now, before I talk about this point further, I'm going to freak you out, perhaps, in the next slides, because I'm going to bring in inflation. Now, interest is paid by the bank at a nominal level. So what I mean by nominal level is that's just a dollar amount. The banks actually don't tell you how much you really are earning, how much more you can buy with what you save, and that's where the cruel joke lies. How much more are you able to buy when you are saving up with a bank? So in this display, you can see how the accumulated wealth over 10 years changes when I actually adjust the interest rates for inflation. So prices of goods have actually been rising on a steady basis over the past 40 years. And inflation was much stronger in the late 80s and the early 90s as a result of the the global economy trying to digest the high inflation caused by the movement out of the gold standard, the oil crisis, and also the recession of the early 1980s, and also within Australia itself, the fact that we moved from a fixed dollar to a floating dollar against the US dollar. So you can actually see that the interest rate this time round is not just how much you actually receive in your bank. We are now stating it in terms of how much more you're able to buy of goods and services in Australia, and that is adjusted for changes in prices over the same period. So for 1985 to 1995, on average, your purchasing power actually increased by about 4.3% per annum. So each year, by depositing it into a bank, you are actually earning an extra 4.3% in terms of your real terms of what you can buy. And during this period, your purchasing power was actually increased at a rate of between 2.25% to 6.7%. Again, those were the pretty good days because you didn't need to take much risk and your true wealth was increasing. And over that 10-year period, your accumulated amount in the bank would have been about $74,000. So you had an actual increase in earning power of 24%. Now between 1995 to 2005, when we had the recession of 93, we also had the Asian crisis and the dot-com bubble. It was actually a pretty bad time to invest with a bank because on average your increase in purchasing power was actually negative. Even though the average real interest rate was just a bit over 0%, there was a protracted period of negative real interest rates being earned when you put it into your money into a bank. What I mean by negative real interest is that the interest that you were earning on the bank deposit is lower than the price level rising at the same time. So the bank might pay you 2%, but actual goods and services went up by 6%. So you're worse off by 4%. So over that 10-year period, you would have actually lost almost 3.5% of your actual purchasing power had you put your cash into the bank. Over 2005 to 2015, the result was similar. You earned a negative real return on your bank deposit, even though the interest rate on average was less than 0. In the recent 3 or 4 years since the subprime crisis, there was actually a period of weaker price rises, even though the interest rate was quite low. So in other words, while you were earning less on your bank deposit, the prices of goods were rising slower. So therefore, you were still able to buy a bit more than what you actually could if you did not invest it into a bank and just held it at home. Now, for 2015, if we projected over the next 10 years and assume that the conditions prevail, you will actually earn about 1.2% increase in real return. So your real interest rate would be 1.2%, and over the 10-year period, you would have a very, very modest increase in your wealth of about $63,500, of which that means about 6% you have earned 6% actual increase in your purchasing power over 10 years. And I do this also in the case of looking at the actual real 1-year term deposit rate. So you can see that if you actually put in a high interest bank account, your real interest rate would be higher, but how much more are you actually able to make? And you can actually see it's really not that much additional return. So from 1985 to 1995, your interest rate, your actual real interest rate would have been approximately 11%. But then because the interest rate started falling in the early 90s, compound interest would have actually worked less in your favor. So at the end of the 10 years from 1985, you will have almost $78,000 in your bank account, which means that the interest earned over that 10-year period will be about 29%. So that's just a little bit up from 23%. And for 1995 and 2005, you have done a bit better. You will actually have a real rise in your purchasing power from negative 3% and negative 1% to 9% and almost 11%. But it's really nothing to write home about. And it's actually quite discouraging to look at how it is in a more recent period. So if you invested from 2015 over the next 10 years at a 1-year term deposit rate, you would probably expect to make a real rate of interest growth of 1.75%, meaning that at the end of the 10-year period, you will have $65,000 in your bank account in real dollar terms, and that means your interest would be just less than 10% over the 10-year period. So this should show you why newspapers are just trying to not talk about savings and focus on loans, because it is not good news for savers. And what is more unfortunate are pensioners, because pensioners can't really go and borrow. In fact, most pensioners would have wanted to have a higher rate of interest in order to sustain their post-retirement living. Similarly, for young people who want to get into the housing market by saving up for their first deposit, low interest rates really don't help them. And when they have bills to pay, when they also want to maintain their lifestyle of dining in nice places, going on overseas holidays, low interest rates trap them even further. So there is actually a link between why low interest rates lead to poor savings and then lead to more borrowing, which helps banks at the moment because they pay a low interest rate for your savings and they are earning much larger amount, absolute dollar amount of on your mortgages, because you have to borrow a lot higher amount, and even though they're charging you a lower interest rate, you're paying a high amount of interest on a regular basis. I'm going to show you in the future episodes the cases for borrowing, but it should now be pretty clear to you that whenever newspapers talk about low interest rates, they're usually going to focus on improved economic confidence, business confidence, and it will help it will help people in the paying off their mortgages to pay less on an annual basis. They'll make no mentions about the truth. They'll make no mentions about the hidden negative effects of low interest rates on common sense financial management. And this is what I find to be quite worrying, because this is not even rocket science. And I could explain it, hopefully in a manner that you're able to understand, just by applying rather simple high school mathematics. And yet most of us are unaware of this. But hopefully you as a listener are now able to see the truth behind the what they're not telling you and what is hidden in plain sight. So tune in with me for future episodes as we go more into this whole low interest rate environment and just pull under the cover to see what types of cockroaches lie underneath. And from here on, I also would like to challenge you to think about the alternatives to saving more effectively. And one way that I would like you to have a think about would be to see how precious metals, such as gold and silver, bullion and coins, may actually be an alternative. It might not be the most risk-free alternative as prices rise or fall significantly. But if you would like to learn more about this, I suggest you go and watch Mike Maloney, The Hidden Secrets of Money. And I'll post a link in my comments and comment section so that you're able to go and look at that as well. So that's it for the episode. I wish you all the best, and I'll see you soon. God bless.